All right. Okay. Thank you so much for coming for tonight's Hong Kong FinTech Week Crypto Drinks. Really happy to have you for that event on DeFi. I have two great co-panelists with me. We'll just kick off this panel with quick intros. So I'm Adrian. I'm at Worldpay. We're a big merchant acquirer, and we are betting big time on crypto. That's one of our biggest verticals. And we've been working with major exchanges since 2013.
Thanks, Adrian. Hello, everyone. I'm TianTian, co-founder of Amber Group. We're a crypto finance company, roughly 500 people spread all over the globe, Hong Kong, Singapore, Taiwan, Korea, the States. And we're involved with pretty much everything as it relates to crypto finance in the secondary market. So trading, borrowing, lending, and in DeFi, we're a user, market maker, liquidity provider, and we've also built DeFi products and incubated projects as well.
Amber does it all. My name is Leslie Lamb. I'm CMO at CoinFLEX, which is a crypto futures exchange. We aim to be the home of crypto yield for both passive investors and active traders to earn and trade crypto.
Awesome. Thank you, Leslie and TianTian. So the purpose of this panel is to give you a high-level view of DeFi. Like, we've heard about DeFi for a long time, well, 2-3 years, which is a long time in crypto. And there are many promises that have been made, and we'll look at what of those promises have been kept, what is the value add of DeFi effectively, and in a second stage, we'll look at what are the expectations for DeFi, what are the prospects ahead. So without further ado, I'll start with my first question for TianTian on the value add of DeFi. And interested to know more about how DeFi has changed the crypto infrastructure, the crypto ecosystem.
So I think it's worth probably defining first what DeFi is, right? So DeFi stands for decentralized finance, which is a new form of blockchain-based finance using smart contracts. At the moment, I think we're now north of 200 billion or so of total value locked in DeFi, and we have protocols and applications ranging from borrowing and lending and trading and everything in between. I think DeFi represents a paradigm shift in how we transact or how value is transacted, in particular because it is permissionless. So what that means is, unlike traditional finance or even kind of legacy traditional or CeFi, centralized finance within crypto, it allows you to interact without middlemen. So everything is peer-to-peer or peer-to-protocol by default, meaning there's no rent-seeking middleman in between, and essentially what that has created is this massive market where value creation, essentially is done by the community, and as a user, you can now not only be a user of the platform but also an owner of these platforms as well. So I think the kind of three biggest changes that DeFi has made to the market structure, first and foremost, is the ability to access products which perhaps previously were inaccessible to certain market participants. So at the moment, right, it doesn't matter if you're an institution or an individual, you can partake in these financial instruments which previously perhaps were very hard to access. And you can do so without a KYC from anywhere in the world, as long as you have an internet connection and some money to pay for gas on the blockchain. I'd say the second kind of second point as to why DeFi represents a paradigm shift, and this is perhaps more true on Ethereum than many other blockchains, is this concept of composability. And essentially what composability means is, if you zoom out and look at traditional finance, you have different products existing in silos, right? So if you if you want to trade a stock, right? Your bank account and your brokerage account, they don't talk to each other. In DeFi, you can have different developers building different things, but through what is called composability, you can have essentially these smart contracts interact with each other in a way that allows for procs to be built on top of each other. So one such example is if you take something like a compound finance or Aave finance, which represents or which are essentially borrowing and lending platforms, and you have let's say Uniswap or SushiSwap, which are these automated market makers. Me as an independent developer, I can plug these two together, bridging together the logic of these smart contracts, where I can build a margin trading platform where every time someone transacts, they automatically borrow from an underlying borrowing and lending market, and then they trade on, say, a decentralized exchange. And this can be done without me having to ever speak to the developers of Compound or Uniswap or Aave. So I think that's the second point. Composability allows for developers to build whatever they want, and hence, we've seen this Cambrian explosion of applications and projects. I think the third point has to do with liquidity. So taking a very real and tangible example, looking back over the past 12, 36 months, you now have most altcoin liquidity in kind of long tail assets now traded on AMMs like Uniswap, SushiSwap, Pancake, and Balancer, because of AMMs, or automated market makers, which essentially allows for anyone to create and bootstrap liquidity using this formula called X times Y equals K, and these bonding curves. So I think this has, looking back 36 months ago, most or all altcoins you trade on kind of smaller or mid-tier exchanges. Now, if you're a token issuer and you want to bootstrap liquidity in your platform, in your token, you don't need to go and apply for a listing on an exchange anymore. You can do so by clicking a few buttons on Uniswap and then incentivize liquidity going into that platform. And hence, most long tail assets now tend to trade in DeFi because of the kind of ease of kind of kickstarting these markets. Yeah.
Thanks, TianTian. So actually, you just pointed out the third topic on liquidity provisioning. So that's definitely something that has democratized crypto, enabling users to bring liquidity to platforms. And on this, Leslie, I'm very interested in having your view of how you at CoinFLEX, and also generally, you view liquidity provisioning being something that is a big value add for that DeFi is bringing to crypto.
That's a good question. And I think TT set it up nicely, explaining what an automated market maker is. But I'll just kind of pose one question to the audience here, which is, who of you guys would consider yourselves a market maker? 2, 3. Okay, so very, very few people, right? And that's sort of expected, because if you're not coming from a trading first background, whether it be in traditional finance or you kind of started in the crypto native ecosystem, market making is not something you just jump into and expect to understand how to on-ramp into the space and understand the market structure and understand what to trade and how to trade it, right? It's a very complex concept to understand, and that's because an automated market maker is, a very DeFi native or a crypto native primitive. And so that's what we've been building on over at CoinFLEX. We've taken this DeFi primitive and we're innovating on it, for the futures market. So we've built the first AMM product for the futures market. And what we're trying to do here is support that experience of being a market maker through what we call educational UX. Because, at the end of the day, like, a lot of people think, oh, a very minimalist UI equals a very simple product. And that's not the case when it comes to automated market makers, right? If you were building a token swap product, perhaps a very simple UI does kind of correlate with that very simple tool. But when it comes to an automated market maker, there are this notion of being a liquidity provider, right? Being a market maker is not something that is natural to understand. And so if you look at Uniswap or SushiSwap, right? What are these automated market makers building on? Those are the spot markets. There hasn't been one that's been built for the futures markets before. And the reason why it's important that one exists for the futures markets is because that really allows the AMM to offer features that a Uniswap and a SushiSwap doesn't offer. And so those two things are primarily leverage, access to leverage, and also access to multi-collateral types as well. And so for context, right, the futures markets trades multiple times more than the spot markets. So if you look at a Uniswap, total value locked might be $6.5 billion, but it's only trading a fraction in terms of the volume. So it's about $1 to $2 billion. But when you look at the CoinFLEX AMM, for example, total value locked is, of course, much smaller. It's about 100 million. But in terms of the actual volume that's traded on the platform, that's roughly between $200 million and $1 billion. And that is thanks to what I mentioned earlier about access to leverage, which allows you to have the capability, right, to one, trade a lot more. And so when there's more trading volume on the platform, there are more arbitrage opportunities as well. And that's all being done by bots in the background, by the way. And so when it comes to this second aspect of having access to a lot of collateral types, that means if you have an asset that's yielding no yield or very little yield elsewhere, such as Doge, for example, and you said, you know what, I want to put some Doge to work, but I don't want to trade Doge as the market pair, right? I want to trade ETH, or I want to trade Bitcoin, USDC, for example, which are both fairly liquid pairs. You can do that through the AMM with your Doge. And so that obviously makes it such that you have a more capital efficient experience, number one, but two, you're optimizing on your balance sheet, right? Because that means you don't necessarily need to have something in order to trade whatever pair it is that you want to trade, which in the case of a Uniswap, for example, you have to put up both collateral. So if you're trading Ethereum or USDC, you have to have 50% of ETH or 50% of USDC to put up in that particular pool. And so all this to say that, you know, when it comes to automated market making, even though like there are only about like 4 of you guys who put your hands up, there's no reason why each and every one of you shouldn't be able to become a market maker, you know, and all that's doing is really allowing you to capture yield in crypto in just a very different way. And as like TT was saying, the market structure is so different now, such that the narrative around crypto yield is also changing very, very quickly. And so as more kind of automated market makers get built, maybe there might be another one on the futures markets. There's just different ways to capture yield. And I think that's what we're going to be talking about later as well, is that aspect of, you know, not kind of settling for the current way of doing things, and always kind of, especially through DeFi, being inspired by innovation to figure out, you know, how to earn more money. And that's ultimately why a lot of people are in crypto right now, I think.
Thanks, Leslie. We've actually touched upon like those value add items that DeFi brings to crypto. And now that we've touched on those, what are the promises that have been kept? We're looking now at trying to understand what are the future prospects of DeFi, what is to be expected. And as a user, as a crypto user, first getting into DeFi, I was using my MetaMask wallet, and I had no idea how to get into space. And now being in the payments world, I feel that there is a lot of that can be done to bridge traditional finance, your bank accounts, the fiat money you have in your bank account, and DeFi. And actually, I'm very interested in understanding like what's your experience around payments, and what's your view of how DeFi's adoption could be enabled by bridges, or whether DeFi's mechanisms can be self-sufficient and do not require those bridges, and maybe be competing with what is existing at the moment. So I'll first turn that to Leslie.
Yeah, so I think, when it comes to crypto, one of the biggest asks by people who aren't already crypto native, so-called in that category, one of the biggest questions they ask themselves is, how do I on-ramp into crypto? How do I buy crypto, right? And there are a number of ways of doing that. Of course, you can go to OTC desks, you can buy straight from exchanges, and that requires KYC, right? It is the system that we've come from in traditional finance, and that's been largely brought over to centralized players. And that's been very necessary, I think, up until this point, especially for, institutions who are trying to get into the space. When it comes to trading lots and lots of volume, we need to know who we're dealing with. And so that's been kind of the notion, right, to support all this kind of flow that we've been seeing over the years in crypto. I think it's very important that credible players have come into the space to enable the space to flourish. But as DeFi has kind of come onto the scene and disrupted the way that trading happens, in the sense that it's not always the case that you need to go through a middleman to buy or sell your coins, the expectations have also changed. It's not necessarily the case that you have to KYC with a platform. Why is it that I have to give up my entire profile just to buy and sell a few things? Like, what is it to you, right, as the counterparty? And so when you're able to go direct to protocol, as TT mentioned earlier, there is this notion that, look, the on-ramping experience doesn't necessarily need to require KYC. And so if there are these sort of payment rails that can be built in DeFi, such that you can in some ways get fiat onto DeFi, it's going to be quite challenging, because the notion is, if you're dealing with fiat, you're dealing with banks, right? And because of that, it's necessary to kind of go through KYC. So, I mean, I know, TT, you have some thoughts there about, could there be a world where there are on-ramps, right? This on-ramping infrastructure that doesn't require actual KYC, from the user, because maybe 5 years from now, people will revolt at that idea of going direct to protocol but needing to give up information.
Yeah. So I think the on-ramping of fiat into crypto is an obvious pain point, and I think anyone that's interacted with DeFi, will know how of an intimidating experience it is, right? You have this little fox icon at the top of your browser. You have a hardware wallet. You have a key you have to back up. Where do you even start, right? Like, once you've set up the wallet, where do the funds come from? So at the moment, most people on-ramp through some centralized intermediary, whether it's an OTC desk or an exchange. And so obviously, with regards to payment, the lowest hanging fruit would be, like, if I can directly, using my credit card, be purchasing, spending fiat and getting crypto into my DeFi wallet directly, that'd be awesome. But I think it is probably hard to imagine that merchant or that intermediary that's facilitating that transaction to begin with being able to take on these type of transactions without any KYC, which then also means that someone that could fill that role, right, is just redoing the work of these existing intermediaries in crypto. I think what's more interesting to think about is how potential kind of DeFi primitives can extend into the existing payments infrastructure in the real world, so to speak. There are some examples I can give her. So Amber incubated this project called KeeperDAO last year. We now have roughly 20 developers spread all over the world, where I've never met a single one of them, and they're all being paid. They're all being paid in crypto. I don't know who they are, and I don't have the time or energy to go and be sending out 20 bank wires every month to pay their salary. So instead, what we're doing is using DeFi primitives. We have these smart contracts that allow, through this platform called Sablier, where essentially we are streaming their salaries to them in real time. We click 2 buttons and their salary is being streamed to them in real time on the blockchain. So imagine if you had, you're making X every month, instead of waiting till the 30th every month to get your, salary in one lump sum. If you can claim your salary every single block, right? Every 12 seconds, you can earn a portion or a fraction of your salary. So that's one way in which we're kind of circumvened the traditional payment rails to kind of offer a more convenient solution for our developers. I think there are other obvious kind of examples here as well. Like, if you look at something like Curve Finance, which is a stable coin, it's an AMM focused on swapping and trading stable coins. For anything up to maybe like $500,000, the liquidity is very comparable now to the top of book spreads on top tier exchanges like Coinbase or Binance, which means you have liquidity being much deeper now in DeFi than their kind of CeFi counterparts. And it's also not hard to imagine that if you had multiple stablecoins in different currencies, you could bootstrap an FX market this way, where if I had to send money, right, from dollars or Hong Kong dollars into euros or other currencies, I can in the future go directly via these kind of DeFi pools as opposed to traditional payments rails.
There's one more thing to add as well. Something that we haven't talked about and definitely will not have time to go through in depth for this conversation, but it's interesting to think about is digital identity and kind of what that means for the future of KYC. Maybe it's not exactly anchoring on the variables that banks care about today, but looking at what digital identity means and how that's formed in Web3, right? What if you had a digital identity in the form of a passport, where your trading activity on exchange or within a protocol? What if your staking activity of a token in a DAO? What if your credit history through borrow-lend activity across different DeFi protocols? What if that became your KYC, right? And that formed the digital identity that then determines, your sort of credibility within crypto. And that is what, maybe the payment rails of the future actually care about, is looking at variables that aren't necessarily formed today, but through your increasing DeFi activity or just crypto activity in general, can allow these payment providers to anchor on different variables. So, I don't know if you guys have any other thoughts on that, but it's just kind of looking outside of the current framework to say, look, Worldpay is going to be around for quite a while, and really just getting started when it comes to crypto. What other things can you guys look at besides just the traditional marks of what makes a person a credible person to deal with, that a bank, for example, would consider reputable, right?
So, on that, KYC and AML is definitely something we have to address on a daily basis in the payments sphere. There is no immediate solution to that. All of the examples you're giving are actually great ideas for us to, with big data, to actually build some indicia of what KYC could be. So I think those are great examples. You would be surprised at how the payment networks, the acquirers, the aggregators, all those players in fintech are looking at building those bridges between traditional finance and crypto. There are initiatives with Visa and MasterCard around settlement in USDC, and those are networks we work with. We really understand that there is a bridge to be built here, but the KYC aspect is definitely I think the major roadblock. You've actually touched on other points, which are almost like disruptors, and I'd be interested in having your view of like what are in your mind are the next big things in DeFi, and what could be disrupted.
So I think there are two main categories. One is definitely gaming. How many of you are gamers here?
More than market makers.
More than market makers, yeah. Oh, hopefully. So I don't know if you guys have heard of a project called Loot, but they basically went to market with the items first, not the game, but the items. And these items don't even have visual representations attached to it. And typically, that, along with a game, is what kind of comes out and entices people to participate, right? But Loot was basically built kind of from a grassroots level. This guy who founded a really popular app that's now shut down, but called Vine, and he went to market not necessarily with profit motives in mind, but saying, hey, look, if I experimented with the idea of building the items first, and letting the community take these items and figure out games around it, what could that look like, right? How could a sort of open source game, kind of be built just as successful as a game that would be, I don't know, built by Unity or by Epic Games? And so I think when it comes to kind of the other side, so not looking at it from the game creation side, but the user participation side, there are also different ways to design incentives that DeFi enables, also with the help of NFTs as well. So in the traditional kind of gaming world, you might say, look, I've amassed years and years of experience and money as well playing this game. I don't want this developer to go down, because if they do, so does all of my valuable items, right? But in these sort of Web3 games, the idea behind it is interoperability. So you have items that you've bought and characters that you've grown, right, leveling up. Why can't you take that same character and tools, or loot, as it's called in games, and use it to something else? And this other game that has no relation to a current game that's built by maybe a studio. Why couldn't that happen? Right? And so when you increase the sort of velocity of trading of these items, you make them valuable, you create NFT tokens basically around these items, all of a sudden, as a user of a game or as a participant, you have so many more economic incentives that allow you to grow with games and grow with the ecosystem. So I think definitely GameFi, as they call it, so gaming plus finance is one, and play to earn, that's probably another trend that you guys have heard about through games like Axie Infinity and Avagachi. These games have grown into the billions, and in terms of user counts, millions and millions of users. I think you just gave me a stat like Axie Infinity. I think like what people can earn from that is 10% of the Philippines GDP.
Axie market cap.
Axie market cap.
It's 10%.
It's 10% of Philippines GDP, and that's really, it's really surprising, right? But at the same time, not as well, because they were the first game to kind of come out and promote the idea of play to earn. So I think these two trends, and of course with reputation, online reputation, social tokens, right? Being able to create a reputation online in the digital world, maybe in the metaverse, that is different from the one that you carry today, like with your existing bodies walking around in the physical world. Having these sort of DeFi components or Web3 components that allow you to create a whole nother identity online, that's also something else that people are trying to explore right now. And when you have all of these things combined together, it makes for a much more interesting experience as a Web3 participant to do basically a lot of the same things that you do here in the sort of traditional physical world out in the metaverse, right? So it's very exciting.
For anyone that owns Loot, we actually built a visualizer called Lootswag. You can check that out at lootswag.io. With regards to where DeFi is going, or kind of areas which I find interesting, where we have not yet seen primitives being built, there are three areas in particular which I think are pretty interesting. One is composable derivatives. If anyone studied finance or financial engineering in school, right, there's this concept in financial academia called no arbitrage pricing, which is this idea that two instruments with the same economic payoff should be trading at the same value, right? Now, in traditional finance, that is not the case because of market friction. But this idea, right, is that let's say if I have a seller of a funded put, instead of having to find a buyer on the other side, I can match that against a call buyer, right? A call option, a buyer of a call option, and a seller of a funded put, they can be netted off with perfect economic netting, right? This concept is called static replication, where I can replicate two products from kind of inception and holding them until maturity. The economic payoff is exactly the same, holding constant all the underlying products, right? Now, in traditional finance, this is just academia. It's theory. In DeFi, because of composability, they don't have to be theory anymore. Through composability and flash loans, this can actually be utilized in practice. So that's one area I'm pretty excited about. Essentially, protocols that bridge together derivatives, where you can essentially net off risk and in a capital efficient way. I guess the best example here is if you take something like a Uniswap LP share. If I have two tokens, I put them into Uniswap, I now become a market maker, like Leslie mentioned. I become a market maker by default because I have two tokens that are spread out or across this kind of bonding curve, where I provide liquidity by default, no matter if the market goes up and down or down. Now, if you were to actually draw out this payoff diagram, it looks very, very similar to that of having sold an at-the-money straddle or strangle, which for everyone that's not from a financial background, simply means you're selling a call option and you're selling a put option. So your payoff of being a market maker in an AMM is kind of replicable by essentially selling a call and selling a put. So with composable derivatives, or these kind of composable products, perhaps I can become a market maker in protocol A, and I can hedge off that risk in protocol B, which is an options protocol. And if these risks are perfectly matched or offset, I can net this off where I put up zero capital and simply conduct an arbitrage. So that's one area I'm pretty excited about, composable derivatives and static replication. A second area I'm excited about is social trading and trade following. So there is this company, which is, they're absolutely massive. They're called eToro. And for anyone that hasn't used it, it's essentially a social trading platform where the idea is you have a brokerage account and the whole world can see what you trade, right? You can see your performance and you can see what your friends are doing, how much money they're making, and you have these kind of leaderboards where if you don't want to be bothered following the markets every day, you can simply follow someone else. You see someone is making 100% every 2 weeks, you just tag along. Every time he trades, you trade alongside with him by default automatically. Now, this is a very powerful concept, and eToro is I think one of the largest fintech companies in the world now, but it has some problems, namely this problem of kind of incentive misalignment. So if you look at eToro's leaderboard, the turnover is extremely high, because it is in your interest to be setting up as many accounts as possible, to be doing random trades, hoping one of them does really well, and then gaining a lot of followers. And when you have a lot of followers, you simply direct those trades into some small penny stock which you're long elsewhere. So this basically means, right, for you as a potential user or trade follower, whilst it looks kind of optically very attractive, it's kind of like because the turnover is so high, generally speaking, like you'll be getting wrecked because of it. Now in DeFi, or kind of with potential crypto incentive token or kind of token designs focused around incentivization, it's not hard to imagine DeFi protocols being able to tackle this problem and solving this incentive misalignment. Right? Essentially, what tokens allow you to do is to align interests or align incentives between users, protocols, and so on. That's the second area. I'm pretty excited about social trading. And then the third area is unsecured lending. So if you look at the borrowing and lending markets now in DeFi, they're pretty capital inefficient, right? If you look at Compound or Aave, the largest borrow and lend platforms on Ethereum at the moment, there's no such thing as under-collateralized lending, right? If I want to borrow $100, I have to first have $150 worth of another asset. So, I put up $150 worth of ETH, I can borrow $100 worth of stable coins. Now, this is extremely capital inefficient. With on-chain, potential kind of on-chain credit scores or some sort of reputation system, like what Leslie was alluding to earlier, you could potentially have, every borrower could potentially have an on-chain credit score, which would be possible, assuming that funds stay within or within DeFi or on the blockchain, because you can see then what funds are being used for, where yield is coming from, what the borrower is doing. It'd be the equivalent of like you depositing money into HSBC and seeing exactly where those funds are going, right? For every mortgage loan they give out, like what's the value of that property? You can see that in real time. You can see liquidations in real time, and you can govern over the platform with tokens in real time as well. So yeah, unsecured lending is the third. So composable derivatives and static replication, trade following, and unsecured lending are kind of the three areas I'm pretty excited about.
Cool, thank you. So on that, not a disrupting item, but more a trend I'm seeing in DeFi is the increase of regulation, and that's not something that anybody is excited about, but it's something that is coming up, and I think it's interesting to just be aware of. So I'll just give you three examples. First, Hong Kong, the latest papers by the FTSB, SFC, have mentioned peer-to-peer within their remit, their scope. That's one. And P2P being DeFi. Second, the FATF, which is a global organization that is providing guidance on KYC and AML, has released a paper recently, also including DeFi, within the scope of what should be regulated by governments. And Hong Kong, Singapore are part of FATF, so they will likely then adhere to this. And third, overnight Hong Kong time, the U.S. Treasury released a consultation paper mentioning that stable coins should be regulated, and they're asking Congress in the U.S. to pass a bill to that effect. And if that doesn't happen, they just are recommending Joe Biden to just pass an executive order to actually make stable coins some kind of bank-like feature. So with bank-like regulations. So in the U.S. it would be the OCC, the Office Control of the Currency. So and stable coins being a very important part of DeFi, because that's how you on-ramp. That's what we've explained before, the on-ramp, USDC Circle stablecoin, for example, being one of them. If you have those stablecoins starting to be, and the issuers, such as Circle or for USDP Paxos, if those issuers start to be seen as bank issuers in a way, then that will change a lot of things in the space. And for people like me, it's exciting. Probably not for the traders out there. So I see that as a big trend, and that could actually disrupt a lot of things in the industry. Meaning that right now there is really some what we call in the legal jargon regulatory arbitrage, where you tend to go where as a user or as a government you try to set up like a lenient system, or as a user you try to go trade on the platform that's compliant, and that may change. So remains to be seen, because up to now the regulatory framework has been globally quite far behind the technological advances. So maybe we shouldn't hold our breath, but it's interesting to know that it's happening. So I'll just want to ask the final questions because we were running out of time. Asking both panelists, what is your favorite DeFi project?
I personally like Uniswap, primarily because Uniswap V1 and V2, it took a very simple math formula and created this primitive, which has given rise to a multi-billion-dollar market. And I'm particularly excited about Uniswap V3 because what Uniswap V3 allows is essentially range orders, where instead of you as a potential liquidity provider spreading your liquidity across the entire price curve, you can now commit to only providing within a certain range. And the reason why I think this is cool has to do with the kind of earlier point I mentioned around kind of static replication and composable derivatives. If you think of a liquidity provider's position in terms of economic payoff as being short and at the money straddle or strangle, which continuously restrikes itself depending on volumes per unit of liquidity, it's a bit of a mouthful. What Uniswap V3 allows is through range orders, you can actually create covered calls, puts, and everything in between with almost exact replication. So providing liquidity only between range X and Y, say Ethereum right now is called 4,000. Me providing liquidity between, let's say, 3,500 and 4,500 means that below 3,500, I only have ETH. Above 4,500, I only have stablecoins. This is essentially exactly the same exposure as me owning Ethereum and having essentially a covered call on top. So why Uniswap V3 is cool and why I'm excited about it is because as a new primitive, it allows for entirely new, or not new products, but essentially option markets to be implied from an AMM curve. And I think this is cool because, I think there's generally two types of DeFi projects. One is the type which copies and pastes kind of traditional financial concepts into DeFi and putting them into smart contracts. And the second are the types which create entirely new primitives from scratch. I think Uni V3 is the latter.
Yeah, and just really quickly on my end, one of the more interesting DeFi projects that I learned about quite recently through an interview that I done through my podcast is Avagachi. They're DeFi-powered NFTs, bring together that financial aspect with gaming aspect, with social community aspect, and they're building the first DeFi RPG, so role-playing game, and it's super exciting to be able to see. I think people adopting crypto through social means, through kind of cultural bonding, ways, not technical at all. It's just how people interact, kind of socially in the physical world, being brought into Web3, but really, powered by new incentives, right? New ways of forming community, new ways of climbing the leaderboard on games, which is oftentimes the way to go and what people are motivated by. And so, yeah, I would say check out Avagachi. There's tons of people live streaming the game, but also look out for their DeFi RPG game.
Awesome. Thank you so much. So Uni and Avagachi. We'll open the floor to questions. We have like 15 minutes. Anybody has questions on straddles, calls, and colors? No? Yeah, I'll just tell me. I'll repeat it.
What is the future of hedge fund when now anyone can participate in a decentralized hedge fund with more flexibility?
So the question is, what is the future of hedge funds when everybody can now participate in hedge funds with more flexibility? Maybe a question.
Yeah, sure. I'll try to keep it short. Yeah, that's, I think, the very notion of us building out this AMM product, or really the existence of this primitive, is such that the everyday investor can become a market maker and therefore actually compete with the hedge funds out there and the high frequency trading firms. And when you look at an AMM that's built on the futures markets, that allows you to kind of trade the volume that these guys trade with big teams, right? You need the capital to have the infrastructure. You need the talent as well. You can't have some bozo that you hire from the street to, run these strategies, right? So in that sense, it's really time and capital intensive being a market maker, and deploying strategies, not only in DeFi, which I think is like a whole separate team. Like there are trading firms that have separate teams for market making, on the sort of CeFi side of things, right? Token projects and maybe on other exchanges. And, a totally separate team for DeFi protocols, because it takes, day in and day out, watching those protocols, watching the risks, assessing those risks. And so when it comes to, being an everyday investor and being able to trade, more than 10 times the amount that you put into this AMM, for example, you do have a way to actually compete with guys who spend their entire days looking at the markets, right? And the idea is, once you put on AMM, you can make it as active or as passive as you want to, based on kind of what TT was saying for the concentrated ranges, right? If you set a wide range, you might not earn as much in fees, but you are trading if the market price is kind of within that range, right? Or you can set a really tight range, and if there's lots of market volatility, you're earning lots of trading fees and therefore yield on your basically assets there. But all this is being done in an automated way on the back end once you provide that liquidity into the pool, right? Or through a central limit order book in CoinFLEX's case. So yeah, I don't know if you have anything to add to that.
Yeah, I think it's a very interesting question because you can look at things, either long term or short term, and this whole idea of kind of institutions coming into DeFi, it is a bit of an oxymoron because ultimately, a fund or institution, these are just aggregation vehicles of essentially retail interests, right? Your pension fund maybe has money from a fund of funds, but ultimately it is some individual which owns the underlying assets. And in DeFi, it doesn't matter if you're an institution or an individual. Now everyone has access to the same underlying financial infrastructure or opportunities. So in the long term, I do think that institutions as we know them today perhaps look very different. We already have decentralized autonomous organizations, right, where you have communities kind of governing over things in this through kind of decentralized governance. More short-term or more kind of concretely though, I think there are a variety of opportunities for hedge funds that are active in DeFi or looking at DeFi or just crypto in general. Some of the lending stuff, offer, kind of I think represent some of the lowest hanging fruits. Like if you look at many of the credit hedge funds in Asia or abroad, you're buying, like US high yield at 300 over LIBOR, and this is, single B rated 5-year duration type stuff. In DeFi or in crypto, the kind of risk-free rate is anywhere between 5 to 15%. And so I think there's a massive opportunity right now for any fund or institution that does not have this kind of mental blockade up where they think anything that has crypto attached to it is risky, right? So essentially there's this big arbitrage between rates in the real world and rates in crypto. There are funkier trades to do as well. We are now seeing the rise of essentially the equivalent of kind of these special situations type of trades and activist type of trades, which we see in traditional finance, right? Borrowing money, taking over a company, voting for, like stripping off assets, taking board seats, and kind of doing those type of things. We have the equivalent now in DeFi. The protocol we launched last year called KeeperDAO has a native token with the ticker Rook, like a chess rook. Now this protocol has amassed a treasury of about $120 million, and about 2 months ago, the token circulating market cap was trading flat to the treasury value. So what the community was doing was they were accumulating and buying Rook to then enact a vote to use the treasury to buy and burn the tokens. So essentially creating value in this kind of activist manner, which a fund can do as well, and we are seeing funds doing. There are plenty of such examples in the NFT space as well, where these kind of fractionalization platforms, you have the underlying NFTs trading at a discount to the kind of fractionalized equivalent, which is very similar to kind of ETF arbitrage. If you can buy the underlying S&P 500, each individual single name, and sell the ETF against it, you make that spread. Except now in crypto, those spreads are in multiples of like tens of, or potentially even like hundreds of percentage points. And then in kind of the more for kind of more active trading participants, there's a variety of strategies one can run too. Whether it is kind of arbitraging between different DeFi platforms, arbitraging between DeFi and CeFi, doing liquidations. So for any borrowing lending protocol, if a loan is underwater, who actually goes and liquidates your position? Well, these smart contracts are called by someone, and these actors are called keepers, essentially arbitrage bots, which can be run by anyone, but mostly are done by market makers or kind of trading funds. So there's a variety of kind of alpha right now, like in the market where funds can get involved.
Thank you.
It's okay, you just...
you talked about composable derivatives, right? And I was not exactly sure how that's going to look because if you have, let's say, current Uniswap LP shares or something, and you want to get like, let's say, like anti-LP shares, like because of these short-term positions are inherently like you have to market as a power. How are you going to hedge that if you don't have the same flow, right?
I'll let Tiantian repeat the question.
Yeah, so the way that I'm looking at things is many of these things can be solved by.
Repeat the question first.
Yeah, so essentially the question was how do we create composable derivatives given that with the case of let's say AMM LP shares, the payoffs are path dependent. Now, the way that we look at these things is you can think of composability or kind of arbitrage between platforms as they exist. And you can also think of the potential for entirely new markets to be created. So one idea I have around this is using something called frequent batch auctions, where instead of trading being done with continuous time, it is done in discrete time, where trades clear in an auction. And you can imagine if in this auction, trades, it's not done in an order book, but in a continuous fashion, but in discrete fashion instead, you could have individual markets for, let's say, options, binary options, futures, perpetual swaps, borrowing and lending markets, where then the batch auction itself is able to compose and decompose individual exposures and net them off natively within essentially this on-chain matching engine. So I think this is one way to essentially bootstrap a market for composable derivatives or composable underlyings. I agree that it's very hard to do so by actually kind of arbitraging between individual platforms as they exist today, unless you have super fluid and super liquid markets in many individual kind of underlying components, which we don't have at the moment.
I have so many questions, guys. So a big thing that we're now seeing in like the space is the concept of we talked about DAOs before, right? Like for example, for what you guys really think about like protocol of liquidity, right? So the current renting of liquidity is also only how do you say subsidized by the dropping of the governance overhead. How do you create a long-term sustainable system that is able to basically keep that liquidity in that specific protocol, right? To keep that liquidity alive.
I think one does not necessarily have to take the view that it's one or the other, where as in if there's no incentivization, that liquidity disappears. Because if you look at something like ETH, USDT, right? These markets are now super deep, and yet broadly or generally speaking, we don't really have incentivization in these liquid pairs, and people are providing liquidity because the fees generated are high enough to compensate for the impermanent loss. I do think though for long tail assets, this idea of I guess like Olympus DAO or like protocol owned liquidity is very interesting because instead of giving up tokens as reward to kind of bootstrap liquidity, you own or you sell a portion of your tokens for LP shares, which then you own kind of forever as a protocol. But yeah, I don't think these things are kind of mutually exclusive. Ultimately, it depends on like how much trades come through and if the fees generated are kind of sufficient to outweigh the impermanent loss itself. But I also think many people look at things like impermanent loss as something that's kind of just naturally bad. But in reality, right, for a liquidity provider, it's also a way to exit liquidity. And if you have a view on where prices are going, sure, like certainly, like impermanent loss is bad because for everyone that's not now aware, impermanent loss is essentially this idea that if you're a liquidity provider, you're providing liquidity by default across an entire range, and due to the nature of how these formulas work, on the way down you're buying more and more, and on the way up you're selling more and more. What this means is if prices deviate away from where they were when you supply liquidity, you are incrementally always worse and worse off versus having done nothing. So what you earn in return for that is the trading fees, right, from having taken this position. One common thing, I think what we're seeing in especially kind of smaller altcoins is people establishing positions and then supplying liquidity where the liquidity position itself is a way for them to scale out of their position with time, where instead of kind of waiting for someone else to supply liquidity to hit into those bids, essentially buying one asset and supplying the other side, and then as prices go up, you're scaling out of it, which you would have done anyhow. And so I think over time, right, you're gonna see more and more market participants which have different risk profiles. Some which are market neutral, or perhaps have assets which are borrowed, where an impermanent loss is a problem, and for others where kind of that they're happy to take that delta, and then protocols that own their own liquidity. And so over time, I think these things are not kind of mutually exclusive, where if there are no rewards, then there's no liquidity, because looking at kind of the large cap assets, right, in many cases now, liquidity is comparable to top tier exchanges already.
Yeah, do I? Yeah, it's a question on the regulation side with FATF and the latest paper that they released last week. It obviously catches DeFi a lot more. Do you guys see a world where we have compliance to this? So you have Aave KYC, or a bifurcation where you have some people complying and others that see DeFi as truly DeFi, maybe it's set up with a DAO, they just identity that no one can go after.
Okay, so the question here is the very recent papers by FATF and others regarding DeFi, and basically having that in scope of regulatory frameworks. So I'll speak to that first, and then I'll. I think it's also interesting to have the view of traders from the regulatory angle. This definitely changes a lot of things, as I've said before. Because of that, I've also looked into the market, and I've looked into what products are being built to address those questions. And one example is MetaMask. They want to launch an institutional product, and that could bring in those hedge funds that want to have a high yield, but that don't want to touch platforms that are not KYC. So I look at the market spurred by the regulatory changes, and I do see a lot of new things. So MetaMask, Aave is also innovating in this space. In my view, if there is regulatory certainty, there will be products. Lots of DeFi, lots of crypto players crave for certainty. They crave for having some framework they can follow. This is really what's hindering growth. So I would think that if you have clear rules for DeFi, you will have some growth in this space. And I welcome that, and I found that very interesting.
Yeah, so sort of anchoring on a point that you brought up earlier, TT. institutional adoption through retail demand aggregation. I think if you look at a company like Square, they are building a DeFi platform, albeit on the Bitcoin blockchain because they're very invested in Bitcoin. But let's look at the numbers, right? There are 3.9 million Cash App users, not to mention the number of merchants that are within the Square network. And so with this platform being built where developers can build DeFi projects on the platform, Square is a distribution funnel, effectively, for DeFi projects to the masses, right? To retail, true retail adoption of DeFi products. Maybe. I don't know how it's going to work out. But in that sense, you do have to KYC when you use Robinhood, right? So there's that sense of, I don't know how many DeFi protocols like Aave will say, hey, look, we'll kind of carve out a different product, a sub-product for institutions specifically. Maybe it looks like this scaling option through distribution funnels such as Square, to actually build DeFi projects, not necessarily in-house, of course it's all open sourced, but kind of using that network with lots of retail to actually attract DeFi interest because they're already customers, right? Why not just add a new asset class or add a new product for these guys to invest in? So that's kind of one that I'm thinking right now that is quite doable, and Square is an example of that.
Yeah, I think over time the regulation of like the on-ramps and off-ramps are inevitable. That's pretty much already there. I think regulating actual DeFi protocols themselves is going to be tough because one trend which we're seeing now in the market is increasingly new applications are being built by anonymous developers where you don't even know who is behind these smart contracts. So the FATF, I think 3-4 days ago, just released new guidance where they clarified that you could be defined as a virtual asset service provider even if you're not a centralized platform, but you are simply the kind of maintaining or controlling these smart contracts. I think this is what the market is slowly learning and adapting to, where kind of anonymous launches are becoming more and more common, where you don't know who the developers are. Their contracts are there. They're not kind of there's no name you can attach. There's no team or company you can attach to these products and platforms. So if one were to imagine like a situation where Aave or Compound Labs, like the teams behind them, get subpoenaed or get shut down, the community would simply fork this into an alternative, similar to what we've seen with Uniswap and SushiSwap, where even if regulators wanted to, they could not stop because they could not stop these things because there's no one to go after other than a username online.
So how come regulators have been able to shut down like the Silk Roads, or back before that you had the peer-to-peer music platforms? Is it similar in a way?
Well, I think Silk Road or like or kind of other like these are not DeFi protocols, or rather they're not decentralized applications. So there's a server hosted somewhere by someone. Whereas with DeFi, once you have these smart contracts running on the blockchain, as long as the underlying blockchain works, right, these things keep running, and that's what makes them immutable.
Thank you. We have time for one last question. Okay.
So currently, like you said, all these DAOs have so much money, right? Do you think there's any opportunity or realistic opportunity for hedge funds and institutions to come in to manage these stablecoin funds, but also these native funds in a professional manner, basically grow and maybe even in an organic way incentivize the ecosystem?
So the question is regarding the DAOs and about the wealth they have accumulated, and the use of it.
Yeah, I think if you look at DAOs, right, there are two types of treasuries. One which is primarily denominated in the token, and this is the majority of them. And then you have a much smaller subset which have treasuries, majority made up of like non-native tokens. And I think with both, right, there is definitely that potential or possibility. Speaking from my own experience, like in participating in KeeperDAO, right now there's this platform called Maple Finance, which is essentially an unsecured lending platform that is bridging DeFi with market makers, where market makers borrow unsecured from these on-chain liquidity pools. That platform is now putting up a proposal to manage a portion of KeeperDAO's treasury, where then implicitly these funds should be going to market makers to be trading and managing and paying a yield on it. It is not hard to imagine that potentially a hedge fund could fill that role too, but I think it depends on what potential compliance constraints they would operate under. For many traditional financial institutions, I think they have a hard time interacting with DeFi in the first place because they don't know who the other side is, right? Always having to know who the other side is or kind of who your counterparty is makes it very, very difficult for these kind of non-crypto native institutions to participate.
All right, thank you. Oh, okay, one last question.
So you discussed about digital identity and University of Decentralized Finance. Do you think CBDC can affect the anonymity of consumers or platforms?
So the question is about CBDCs, drawing on our initial conversation around digital identity. And if I understand correctly, it's whether CBDCs are affecting privacy. They're affecting digital identity on this DeFi platforms. Who wants to answer this question?
I think not necessarily. Well, or rather, by default, it wouldn't, because they would be running on their own permission chains anyhow, where I don't really view CBDCs as cryptos in the same sense as kind of Ethereum or Solana or Avalanche applications or Algorand or whatever. They are simply just kind of a digitized form of existing fiat, right? And so. So in short, I don't think that's something which necessarily conflicts with this trend of more and more developers in DeFi going anonymous.
Yeah, I think on CBDC is a very interesting topic. We could do a panel on CBDCs. It's a very big trend in payments, and like China with the yuan is very, very big on that. So needless to say that CBDCs in a way is a bit of an oxymoron with privacy, but it can provide you with a digital identity and can provide you with a credit score. So this is really where you have sort of trade-off between like the conveniency of giving your data, and you get in return instruments that provide you like with helicopter money, with CBDCs, or with interoperability. But then in those cases, you're in effect giving up a lot of privacy rights, and you have digital identity that is shared with governments. So CBDCs is as we're seeing it in payments is a very big trend. And it's especially a big trend in countries that have the power to impose those forms of payments to their citizens. Okay, thank you very much for attending this panel. It's really good to have you. Thank you so much, TianTian from Amber, Leslie from CoinFLEX. Thank you very much. Thank you.